Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Let's travel back in time to the beginning of March 2020. COVID-19 had just taken hold of our daily lives. The stock market dropped 13%, then rose 5%, and commuters roamed the earth. In this episode, Aaron and Trishul discuss how they feel and react to big market movements. They suggest how an asset allocation incorporating a time frame can help you take your mind off of the things you can't control. They also discuss the Hedgehog and the Fox and why people follow overconfidence and headline news when they should be applying a healthy dose of skepticism. And Aaron ends up correct that a couple of months later his focus would be on lifestyle and not the market. Unfortunately, it also means he was wrong about playing softball in April. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hi, Aaron. Great to be here today, and thanks, everybody, for listening.
Great to be here as well. Today, we are going to be talking about how we feel when looking at the market and looking at big swings. And to give you some reference, it kind of bring you behind the scenes of the podcast production. We are recording this on March 4th, and it's probably not going to go out until third week of April or so. So you're probably going to be listening to this about 7 weeks later. And our goal was to record how we are thinking about the markets, how we're reacting to news, how we feel, what actions we might be taking, but making you wait that extra time to listen to it so that you can think back, how did you feel 7 weeks ago versus how you feel now? So a couple things that we're going to talk about are kind of some of the numbers that we've seen, some of the kind of headline news, and then also because we don't know what's going to happen over the next 7 weeks, how does that influence our thoughts and feelings, and kind of when do we react, how do we avoid overreacting, how do we feel, and what are some of the potential actions that we might take. So again, as of March 4th, so we're kind of middle of the day here, we're going to use some S&P 500 numbers from close to close. Again, these are just reference to help you understand how were you feeling 7 weeks ago when you're listening to this now. And as I say that, it feels like time travel, the movie, like trying to describe, like think back to 7 weeks to today. That I'm sure I'll get more confused with that. Are you gonna be okay keeping track of timing like that, Trishul?
Well, this sounds like a fun one, so we'll give it a good try.
Okay, so from February 19th to February 28th, the S&P 500 went down 12.7%. This is from the absolute peak to kind of short-term trough, we saw that big of a drop. The next day, next trading day, so March 2nd, the S&P 500 went up 4.6%. And it's had some volatility intraday, but it's been a little more level over the last 3 days, the second, third, and today. So we saw, again, this really big drop. All the headline news are coronavirus risk, and we don't know what's going to happen. We have no biology or epidemiology experience, so we have no idea what's going to happen in terms of coronavirus spreading or not. We know that we do see these types of drawdowns related to some kind of headline news with not exactly regularity, but fairly often. And so trying to think, how do we react to other things in the past, like SARS or Zika virus, might help us inform our feelings and emotions and thoughts of, in the moment, how do we think we're going to feel over the next month? Does that sound sufficiently complicated for you, Trishul?
Sounds like a good plan. Let's see how this goes.
Okay. So the first thing when these swings happen is the feelings that come with them are fairly normal. That you see these big drops and you just start to feel fear, and you want to see if is there anything I can do to get rid of this feeling or know that I'm going to be okay. And I do have conversations with clients that they are concerned, and this is a normal feeling. And a big part of that is pausing, talking about what's going on now, what are the headlines, how does this affect your investments, and then how does this affect your lifestyle. And so some of the data points that I'd seen, that was a good reference, and I brought up SARS and Zika. Actually did mention this in a few emails to clients. Both those periods also saw drawdowns from peak to short-term trough of about 12%. It's actually was right in line with what happened from the February 19th to the 28th. And they both previous times saw normal recoveries over the span of either months or years. And when you look at other drawdowns, there's always some kind of headline risk associated with that. And eventually it comes back up. We have no idea what the time frame is. We have no idea how long. We also don't know if this is the start of a bigger drawdown. We're not going to try and predict the future. And my general feeling is at this point, this is still kind of normal market volatility, that these kind of drawdowns happen. The headline is different, but the headline's always different. It's always something else. And so when I look at stock market data, one of the first things I try and do is actually look at what's the 1-year trailing. So this is a time frame that I like that removes a lot of the short-term noise, but is still long enough to give us some perspective. So it's not too long to be generational. It's short enough that we can kind of think about it and react, but it does help smooth out a lot of that really short-term day-to-day headline news. And I can actually check the S&P 500, and it's up 10% for the last year, or trailing 12 months. And that's actually right in line with its long-term historical averages, and might even be above what we would have expected March of last year. But that does provide the kind of context of how do you feel about the market, and how do you ignore those day to day, and if you are going to check, what do you look at? So Trishul, at a kind of a high level, when you are thinking about these day-to-day swings, or this 12-day period where it dropped 12%, what are some of your first thoughts and feelings, and how you react to that?
The first thing I'd like to keep in mind, the stock market isn't designed to go up in a straight line. That's just not how it works. There will be bad days, there will be bad weeks, and there will be bad years. That's just part of the game. So that's something we have to remind ourselves. And it's one of those things that's difficult to put into context, because we are right now in the longest running bull market in history. We've seen the largest growth in a market since a recession that's ever happened. So it's probably time for a correction, meaning it's probably time for a dip. So that's maybe one reason why we're seeing it, in addition to the fact that there is fear about coronavirus. But that's all par for the course. So what it makes me think about is the fact that over the past 100 or so years, we've seen some pretty major events over this time. Of course, we've had the Great Depression. We've had various crashes along the way, including the oil crisis of the 70s. We've seen a huge tanking called Black Monday in 1987, where we had a 20% plunge in the S&P in a day. We've seen issues surrounding wars. We've seen the Asian crisis in 97. We've seen the dot-com bubble. We've seen the financial crisis of 2008. What my point is, there's plenty of periods where bad things have happened, but in none of those periods did it make sense to run for the fences. Did it make sense to throw in the towel? So if you add up all of that together, is this the one time where you really should basically pack it in and throw in the towel? I'm thinking not. And over the past 100 years, if the world has survived, I think it'll survive this as well. And also what it comes back to is, what's your holding period? Meaning, what time period are we really concerned about? Are we concerned about a week? As you have mentioned, there have been other viral scares in the past, and things have recovered over periods of weeks, months, and years. So if your holding period is longer than that, then this should really be less of a concern. Now, I understand the fear, of course. There's plenty of that going around. We've probably heard some of these headlines that the outbreak is continuing to spread. We've heard it impact supply chains coming out of China, for example. We've heard the fact that many manufactured goods are sitting at ports because they can't be distributed properly. We've heard of extreme measures of quarantine happening in various countries, especially in China. So there's plenty of reasons to be fearful, but I think there's plenty of substantiated reasons to still stay the course when it comes to investments.
Okay, I completely agree. And I think that there's something about financial advisors when you start looking at data, and they tend not to overreact. I remember I saw a good tweet of just clients' emotions are like going up and down with the market. You see these big swings up and down, and the advisor emotion is just that flat line right through the middle. That I don't really get excited on big days or big years, and it's going up. It's like, oh, okay, that's another data point. But at the same time, I don't get upset about down years. I took 3 notes from what you said, and I'm going to try and address these and some of my thoughts kind of in order. So please feel free to interrupt when you do have a counter. When you said we're in the longest bull market ever and it's time for a correction, I do remember having a conversation with another advisor that, while I don't like that phrase, that time for a correction, because it implies that we could predict a downturn. I think that the overvaluation of the longest bull market is relevant, but we've talked about in the past, we have no idea how that will play out in the future. I think when we go to planning and doing financial plan, it does make sense to use a below average rate of return over the next decade or so. So if long-term stock market is 10%, maybe we assume 7 or 8% over the next decade for planning purposes. But we have no idea how we'll get there. We have no idea if there will actually be a big correction of negative 20% or more. I think, does correction have a technical definition? Is 10% considered a correction?
It does. And that is one definition, yeah.
Okay.
10%.
So I don't like that idea of saying time for correction, because it may or may not happen moving forward. Well, I guess, did we already experience it? And
yeah, I guess my comment was it was time for a correction, meaning we already had it.
Okay.
Postcasting there, not really forecasting.
Okay, love postcasting there. Love, yes, this already happened. I'm very confident that already happened.
I'm good at the looking backwards part.
So the conversation I had with the other advisor was like, and it's exactly the point you made, is the markets going down from the headlines, is it actually just normal market volatility, and this is just happens to be the reason why? That kind of we're even though the headlines are all about coronavirus and COVID-19, is the correction, is it, I don't want to say coincidental, but maybe not, that these aren't the causes? It's just, it could have been any bad news. It doesn't have to be this specific thing. any bad news that comes out could have resulted in this market reaction.
Right. This comes back to, just the terms that I threw out there: postcasting versus forecasting. So as you probably know, what's very common with the news is, at the end of the day, if somebody's reading some financial numbers, they'll say, the S&P was up X, Y, and Z, and the Dow was up Z, Y, and X, and here's why. So we're very good at saying, why things happened. And that's probably great, because we like to answer that question. We're very why beings. So it helps us sleep at night. But in terms of being able to use any of that for the future, well, that's very uncertain. And what likely happened here from a postcasting standpoint is that, yes, it's quite possible that the market was overbought, things have got a little more expensive, and the market was just looking for a reason to revert back to what may be more sensible valuations, and this happened to be that catalyst. So that's quite possible. And again, that's something that we might be able to assume now that it's happened, but being able to predict that for the future is quite uncertain, or very challenging, if not impossible.
Okay, so I want to add one point, but don't want to spend too much time. I think even when I see the headlines of the market did this because of this, I don't even trust that. Even postcasting, I don't think is very accurate.
Right. Well, who knows? Yeah, if it's really useful, but it does provide solace. So
No,
maybe
that's
from
good.
that standpoint.
That's a good point. The next point that you made that I took a note, when we talked about the time frame, and we've had this conversation much more depth in the past, of if you're invested in stocks, your time frame has to be long term. You're looking on the scale of decades if you're investing in stocks. The weeks don't matter. They're just too short to come into play. And so I think I had a conversation with you, I forget which particular day, of, hey, what do you think of stocks being down? And your comment was, I didn't know stocks were down. And I love that. I love the idea of yeah, I don't check it every day either. I think some friend happened to mention something. I happened to look, and oh, this is a thing, and you hadn't looked because no one had mentioned it to you. And that's the path. That's the action you should be taking. And I want to kind of call out and commend you and recognize that yeah, if you just don't look day to day, if you wait a few weeks, then maybe this will blow over. We have no idea, but we're not trying to predict the future. So just, yeah, don't check it every day, and you'll probably feel a lot better.
Right.
Go ahead.
The adage is basically the stock market is the transfer of wealth from the active to the patient.
Is that one of the Warren Buffett ones?
Yeah.
So when it comes to time frame, if your stocks are long term, we want to use bonds and cash for the short term. And in this particular case, bonds did exactly what we hoped them. Over the same time frame, all the dates we mentioned, bonds are up. It's only on the scale of 2%, but bonds going up 2% in 2 weeks is actually pretty big. But this is what's supposed to happen. As people sell off of stocks, we get this negative correlation. If stocks go down, bonds go up. And that's part of what made the 2008 financial crisis kind of unique, was that it was one of the few times that we saw stocks go down dramatically and bonds went down. Because of the reason why stocks were going down was because of the bond and fixed income risks that company had. But even in 2008, treasuries, so when there's not corporate bonds, treasuries were up, I think, over 10%, 10 or 11% in 2008. And that's, again, that negative correlation, that when the risky thing is down, the conservative, safer thing is up. And we're seeing that in real time. And that's one of the things I point out to my clients, that my clients who are older, who might have 6% of the total portfolio in stocks, of which only 30 to 35% is US stocks, they still have 40% of their portfolio in bonds, and the bonds are up. In fact, one of my clients pointed out, she's actually the other side, most of her portfolio is bonds. She has 55% in bonds, and her 1 year trailing was still, I think, 9 or 10% of the time, and her year to date was like -2. I don't remember the exact day I had that conversation, so it might have been kind of in the middle of that drawdown. But it was just the idea that, like, yeah, because she's withdrawing in money from her portfolio, we have it much more conservative, and bonds are doing exactly what we want them to do. And that gets back to that, when you're thinking about investing and asset allocation and what to invest in, time frame matters. That if you're taking money out, you shouldn't be in stocks in the first place.
Yeah, that's quite true. If you think about it over, we've looked at and discussed some of these numbers, but on a 15-year time frame, worst case, without adjusting for inflation, you're about flat. And adjusting for inflation, you're slightly down. And then if you're investing for a 25-year time period with stocks, worst case, you've made money. So if you can hold on for that period, meaning if you're planning on saving for a long time, worst case, you'll probably not lose money and you'll probably make money relative to inflation. The other thing to realize is on any given day, the stock market can be down and it can be up, but on average, you're going to have slightly more winners than losers. That's kind of how it works, because on average, the stock market goes up. So just because you've experienced some downs doesn't mean that that's the new norm. As long as you're bullish on planet Earth, meaning you think Earth is going to do better over the next few decades than it hasn't. And there's strong indications to say that things are getting better. Of course, if the planet isn't better 25 years from now, then we're in a lot more trouble than our portfolios.
Mm-hmm. So do you have your doomsday bunker, and do you stock up on canned goods and bullets?
Not quite. I should probably make another trip to Costco, but I probably won't get there in time for this virus to make it here.
I don't have those as well. I've made a trip to Costco, but it was a normal trip. I didn't notice lines or supplies being out, but maybe I went 2 days before the panic and went to Target yesterday and there was no problem. It seemed like a normal day at Target. So.
Right. And I should also make the distinction that there's a difference between what you might need to do personally to, take the precautions you need to do and what you may need to do in terms of your investments. So
yes,
what I'm doing personally is I'm following the CDC, and the CDC website is saying we're all good for where I am in Pennsylvania right now.
Mm.
But, as far as the stock market is concerned, based upon the rigor and analysis that we've looked into over decades and decades, it seems like staying the course is the most sensible thing to do right now.
Yeah. And I tend to be optimistic regarding Earth. Because I do live in the Bay Area, I kind of already have enough things in case of an earthquake. So I have a lot of water in the garage that I make sure I always replenish. I have a cabinet full of, not full of canned goods, but I have a kind of enough stuff already that I didn't need to add more stuff just because of this particular headline.
Right. I think in general, I always like to filter my fear through other relevant concerns. Like, for example, if I'm going to the beach, I know there's a fear of sharks, but I also know I'm more likely to die by a falling coconut. And it's kind of true for many other things in life where, for example, I've gone skydiving in the past, and I realized the most dangerous part about that expedition is the drive there and back. So just understanding that, yes, there's a risk of a virus out there. I'm not sure if everybody realizes, though, but tens of thousands of people die every year from the standard flu alone in the United States. And as far as disease and other types of health concerns there are many concerns that really don't get the headlines but are still relevant. We all know we have to deal with many of these other diseases anyway. But at the end of the day, there are many tens of millions that will pass away from heart disease, that will pass away from different various forms of cancers, and so on. So it's just something to keep in mind as we're looking at the headlines for this particular concern.
When you said you go to the beach and you're afraid of sharks, I thought you were going to say you're more likely to die of drowning. Did not expect the coconut.
Beware of falling coconuts.
I was actually growing up in San Diego, was not that far from the beach, and one of my summer camps was a junior lifeguard program for a week. And there we learned a lot about kind of rip currents and rip tides, and if you're caught in one, how to get out. But that was my big kind of life lesson from the beach growing up, was kind of getting risks of getting hit on the head by a surfboard, or hitting the bottom, or getting stung by a stingray, or the rip current, and like never give up your flotation device. Those are the risks I think of when I think of going to the beach.
Right. Yeah.
Did not. I guess there's no coconuts in San Diego, so maybe that's why it just didn't come up.
That could be true.
And that's one of the things I'm glad you brought that up, that the headlines aspect. And this is the thing I come back to the most, is how much of news and panic is related to headlines versus actual data. And I love referencing this book called The Hedgehog and the Fox. It's by philosopher Isaiah Berlin. It's written in 1953. And the basic idea is that hedgehogs tend to be loud, bombastic, big personalities, overly confident, and make for great television. And he wrote this in 1953, so I don't know if there's a TV aspect, but it's most common now. It makes really entertaining TV to make big predictions one way or the other. Markets going up 100%. Markets going down 40, where it's a repeat of the Great Depression, or we're going to see another decade of bull market. The fox is the sly, kind of probability-based, not necessarily trying to be overconfident, not predicting the future. This is the few times that a news organization will have a professor on TV and they'll say, what do you think is going to happen over the next year? I was like, well, there's probably a 60% chance that the market's going to be up greater than 8%. I guess there'd be a 10% chance the market's up greater than 15%. There's a 20% chance the market's going to be between the long-term historical average and zero, and probably another 15% chance it's below zero. And while these are really accurate, well, I would say really accurate, these are much more likely to be accurate than the hedgehog making their big, bold prediction. It makes for horrible television. It's a horrible, horrible guess if you're looking for entertainment. And that tends to be the difference that I look for. It's like when people ask me what the market's going to do, it's like, I don't know, maybe go up. That's my guess. Like I'm more confident it's going to be up over 10 years than over the next year. And I try to think like the fox as much as possible, because I'm more likely to be accurate given a big wide range of possibilities. But it's harder to kind of attract followers. And as you hear this idea and you think about what you see in the news, on TV, on Twitter, on social media, what gets those kind of followers and what are people drawn to versus is this actually helpful advice? So when you hear that idea or the kind of distinction that, or the original essay, now a book, The Hedgehog and the Fox, what comes to mind for you, Trishul?
It reminds me of a quote from Francis Bacon. If a man will begin with certainties, he shall end in doubts. But if he will be content to begin with doubts, he shall end in certainties. So it's just the notion that we live in a probabilistic world, a world where almost nothing is certain, and it's hard to be firm about anything. So just beginning with the notion that, X is true and X is dogma, it's just hard to stick to that and come up with a conclusion that makes sense and that won't change. It also makes me think back to just the fact that when you're trading, it's something that I used to do professionally. There's always the room for doubt. There's always the room to say, no, but this time is different. This time, all of that data that we have can be thrown out the window. That there's always that opening of saying, but what if this time X, Y, and Z happens? And what I always find myself thinking is, but that could have happened with anything at any other time. And it's always a thing that you're not thinking about, that you haven't pinpointed, that will likely end up tripping you up instead of that thing that you have identified and you're trying to react against. So I always try to keep that in mind, because there have been so many times when in the past where something bad has happened, and we think that it could potentially lead to the sky, falling from above, and in reality it was just another event where something bad happened and then the world moved on.
I agree. I like that. And I do want to add that, so again, this was written in 1953, but it's come up. It works really well with the kind of television description. So I can have two experts on a show that have completely opposite opinions, and they don't bring the guy or girl on the show who's going to be middle of the road, kind of, I don't know, probably this. But as we've incorporated some of the kind of behavioral finance and behavioral economics and evolutionary psychology aspect, it does help to remember that people as human beings like to follow those big bold predictions, that they like to follow that confidence. Because imagine you were in a life or death situation as a tribe, and one of the guys says, I know what to do, follow me. And the other one's like, well, I'm pretty sure we should do this, but here are the risks. And if we go, here's the other option, and these are the risks. But for the first one, I think that the pros outweigh the cons slightly, but we need to make sure about this. For the second one, there's still some pros, but I think the risk might be a little higher. Which one do you just naturally want to follow? And human beings are just wired to follow the overconfident, I know what to do, follow me. And it just expands exponentially, whether it's through traditional media, social media, and it leads to these big headlines that you're going to follow the person. Like, the market's up 1,000 points, or the S&P 500 is up 5% or down 5% because of this, and I know why. And it's hard to not follow that, and you have to kind of think about that and remind yourself in the moment of, is this actually the case? And kind of force yourself to be skeptical, but not so skeptical that it causes inaction. To find that balance between finding that gray area in the middle, not being on the two ends of the spectrum, but not falling into a paralysis by analysis. And that's really, really hard for human beings, especially large groups of human beings in a society. And that's where panics and overreaction come from.
Yeah, I agree. My mind goes back to, we had mentioned the Serenity Prayer way back in one of our earlier episodes, but it's basically the notion that there's only so much we can control, and why don't we just focus on that rather than the millions of other things that we can't control. And we can control our emotions, hopefully, and how we react to them. And also, we can't control the market and what it does, but we can control the fact that if we stay the course long term, if history is our guide, we should be okay.
Mm-hmm. So, given all of that, how have you done anything different in the last 2 weeks? Has anything, whether it's in terms of your feelings, your actions?
As I mentioned, just for the health of myself and my family, I've kept an eye on what the professionals say in terms of what to do, and then that's the CDC and other
Mm-hmm.
sources, credible sources like that are less sensationalized, for example. But as far as the stock market is concerned, I've titrated what's gone on into what I understand, and I believe staying the course is the most sensible. And that's what I've tried to communicate to those around me, including my clients.
The only thing that I've really done differently, in addition to kind of answering some of their questions, but I try and stay in touch with clients regularly anyways, is on the investment side, are there any kind of opportunities that we could take advantage of? These are things like tax loss harvesting. If one of your investments is at a loss, can we sell it, get that loss, and move to a similar investment? So this can help your taxes for 2020, taking advantage of this downturn. Could also do things like Roth conversions while your traditional IRA is lower. If you're going to do a Roth conversion, maybe do it right now while the market's down and your tax bill might be a little bit lower. Also, for options and exercising options, it does help on taxes to exercise options while the price is a little bit lower. So depending on the company that you have stock options in, if you're an employee, then this could be a good time to exercise those options. And this is not necessarily kind of predicting what's going to happen in the future. It's not predicting the market's going to bounce back up. And if we don't get to it, there's not any kind of magic number of I wait till the market's down 15% before doing this. It's just one of those regular things I'm trying to look at. I'm keeping an eye on client investments and client situations because I care about them, and that's what they pay me to do, is to look for things like this. It's not selling going to cash, but there are some other actions that may or may not make sense at an individual level. Is there anything like that you look for, whether it's just this is the time to rebalance? Maybe that's kind of, okay, stocks are down. Let's check our asset allocation, and our 60% stock portfolio and 40% bond portfolio is now 57-43. Let's sell some bonds that are up and buy stocks that are down and use that as rebalance. Is there anything like that you'll do?
Yeah, certainly. So these are actions that are sensible whenever there's a movement, regardless of the post-casted cause. So the notion is that, yes, when things are down, you want to take advantage, especially from a tax standpoint. And the neat part is, yes, let's say you do have a position that fell 15%. Well, then if you are able to roll that into a similar position and then ride back up, well, then you've just been able to lock away that tax burden and basically shift that. So it's something where you can certainly save. And I feel like that's a lot better in terms of if you want to find a way to provide a little bit of edge on your portfolio, a little bit of a gain, because at the end of the day, there is one certainty, or there's two, I guess. There's death, and then of course there's taxes.
Okay, as we finish up, going back to the time travel theme, how do you think you're going to feel 7 weeks from now when everyone's actually listening to this episode?
I think I'll feel about the same, but in all honesty, I have no idea where the market's going. Could go up, down, left, right, sideways. I don't know, and I can't put a prediction on that. But I think as far as I feel, I'll feel about the same.
I'd be curious looking at a chart that went left.
Or maybe it goes purple. I don't know.
Yeah. I think when I think about the next few weeks, the next 7 weeks, I'm actually thinking like what's going on in my life. it's March, but in April, softball season will have started. So I'll be playing softball on Monday nights, and that will probably be a bigger priority for me. End of April will be so after tax season. So finishing up getting taxes ready for personal and professional, because I'm still waiting on some 1099s. So tax season will be done. So maybe I'll be touching base with some of my CPA friends now that they can breathe and they're done with their their busy season. So I think that's most likely for me. It'll be something personal. It won't be market related per se.
Well, that does sound about right. And again, I'm an optimist. It sounds like you are as well. So we all look forward to more and more good times.
Yep. Well, thank you very much for your time today, Trishul. I'm really curious, and I'm going to try and go back and listen to this as we get closer to releasing it to see kind of how do we feel. And I'm afraid that we're going to have to write a lot of show notes of what happened and what happened in the intervening 7 weeks. But hopefully people listening can use this as an opportunity to think of how they felt 7 weeks ago, and did that feeling change anything in their lives? Was anything better based on actions they would have done then? Or can they see it as just short-term noise, and can they get over that?
Right. And I also think this might be a good chronicle for the next headline that happens to pop up, which it eventually will down the road. Just to put things into perspective, when the next thing comes along, here's a notion of what happened from the last thing. So I think that'll be pretty neat too.
That's a great idea. That idea, there's going to be some other headline in the middle of April that's going to do something. And
yeah, or certainly down the road. So
yeah,
we'll have a good chronicle of how individuals such as us might react to these types of situations.
Okay. Well, thank you very much for your time, Trishul. I really liked our conversation today.
Well, thanks, Aaron. I enjoyed it as well. And thank you, everybody, for listening. Of course, if you liked what you heard, do spread the word. Thanks. Thanks, everybody.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.